and had a obvious bump in early trade, or late trade yesterday, early trade this morning in Asia, went as high as above 97 and has come back a little bit. And before we talk about all things Saudi oil minister jumping into the oil markets yesterday, let's get a sense from our panelists, their views on what's happened in the last month, not what factor they used on the beaches, but what did we all miss from their perspective was the sort of big narratives of the last month that carry through now. Let's start off with our Matt Stanley, long-standing partner of the podcast, and now in his new incarnation. So first time, this is Matt coming as partnerships lead Middle East for Kepler. So Matt, congratulations and best of luck in your new post. What was your sort of big takeaways over the last month that will carry forward?
Morning, Sean. Yeah, thanks for your wishes. I appreciate that. Look, I think it's been volatile as anything. It really has. I mean, you touched on what was happening yesterday. We traded down to a low of 92 at 6 o'clock UAE time, and 4 hours later we were back up to 97. And that's really been the theme of what's happened this year. And it's really been this quite boring narrative, if you like. The push and pull between demand concerns about recession and issues regarding supply, predominantly because of what's happening with Russia, but also, the OPEC are struggling to meet their quotas. July they fell 2.9 million barrels a day lower than they were allowed to produce. So to me, the one thing though is going to be what happens in the EU when it comes to gas, and that really does seem to be the one concern that everyone has. We are facing ridiculously high inflation. They're forecasting, I think, 18% or something mad for UK in August, but supply is still the concern. And nat gas prices are up over 500% since June 2020. Where will they go? That's the issue. People don't know. It's this ambiguity around gas. And Uniper fired up a coal plant yesterday in Germany. So Greta's stomping her feet at the moment. But look, we need the energy.
Maybe she's joining the Finnish prime minister and having a good dance.
Yeah, she probably doesn't drink, Greta, I don't think. Well, I haven't seen her smile for a while, but who knows?
Not old enough yet to drink, I think.
Yeah, exactly. But no, look, for me, Sean, the issue is what happens with gas come really mid-November, what the market does then. It's still facing some headwinds, massive ones with recession, but energy prices will stay high.
Well, let's welcome Sarah Akbar back to the table, chairperson and CEO of Oilserve Kuwait and non-executive director of Petrofac. One place, Sarah, that there won't be a recession, at least anytime soon, is in the Gulf. We had the IMF announcing the other day that they're going to have over $1 trillion windfall from this year of bionic oil prices. That was the sort of big takeaway over the summer. While everyone else was freaking out, the Gulf was enjoying and continues to enjoy a big economic bonanza. Are they going to use it well? I think you're on mute, Sarah. You're on mute. All right. Yep. Perfect.
Good morning, Sean. I think you are absolutely correct. This part of the world is the part that has, made a lot of benefit from this high oil price, and they have accumulated huge funds. They are, for the first time, I can see they are really spending it wisely, because they are putting it in the right direction for developing their own countries, and a lot of that money will go into some of the funds internationally, which will help develop further some of these countries, help out in some of these countries where you have serious recession. Where we can see the recession worst is actually Europe. Other than Europe, I think the rest of the world can survive this current environment, but Europe facing a war, facing shortage of gas and tension. And so Europe is the place where maximum effect of recession will show. But for the Middle East, I think in Kuwait, in Saudi, in UAE and Qatar, these countries, and even Iraq. Iraq today, they have like $80 billion in their reserve in the bank, and the foreign reserve in central bank. So they are in a far more better position than they've ever been. And this will reflect positively on the development agenda that they already have on the table. I mean, I'm sure for countries like Kuwait and, there is big reform ongoing now in Saudi with the plan and the activity level that is really going, crazy now in Saudi and in these countries. So I can see for the first time that these funds are channeled in the right direction to develop the countries and to focus on the country itself rather than just using it in buying stocks, property, and the way that we've been using the sovereign wealth funds in the past.
I was having an interesting conversation yesterday with a senior official in Oman who was saying for the first time they're having challenges attracting talent into the public sector in Oman, which typically in the past has been drowning and having to employ too much public sector. And now they're having challenges attracting because of the sort of dynamic changes and the opportunities in the private sector. Rustin Edwards, welcome back to the table. Of course, Rustin heads up fuel oil procurement at Euronav. Rustin, obviously you've been calling this for a while. We went into the summer, it seems to me, the summer break, where the dominant narrative, rightly or wrongly, was still supply concern. Now we come out of it, it seems it's very overwhelmingly, although not reflected in the oil price perhaps, but demand destruction seems to be the dominant theme. Your thoughts?
Well, demand destruction is still the dominant theme. Sorry to say, though, but with the world teetering on pretty much a global recession, and the comments by the Saudi oil minister yesterday kind of proves the point. You don't say we're going to start cutting production when crude drops 20% because, we don't like the volatility in price action. It's obvious that from what we've seen so far, that the market is building stocks in certain regions of the world. Despite what you see in statistics around the United States and the EU, Asia is predominantly been building crude oil stocks, and that's their number one customer. And so they've got a real issue that the economic slowdown is impacting one of their biggest demand profile centers. You have the competition from the Russian flow coming in. And so now they've got to figure out how do they support oil price from this point going forward with a global economic slowdown sitting in their face. And much to the Middle East looks great, i.e. the center GCC countries, but when you look at Pakistan, Sri Lanka, Western Horn of Africa, Bangladesh, some of the other developing nations of the world, they're struggling, and they're struggling hard. Not only is the inflation impact hitting them, but the source of energy is hitting them because the EU is outbidding everybody for power. And so you do see a lot of diversion of cheap energy going into Europe where the better netback is and the better payment is. So there's a lot of that going on. And one of the things that I would say that has actually changed over the summer break is the fact that tanker freight has taken off like a rocket. Currently, TCE rates on VLCCs are hitting $54,000 a day, according to Clarksons. And we are seeing that in different tanker companies' earnings reports that are coming out, and they're all having forward guidance that means much higher. Now, a lot of this has to do with EU or the IMO CII regulation that's starting to come out as of Q1, but a lot of it also has to do with the fact that you're getting more and more ton miles as Russian flow sucks in certain ships, which takes it out of the, let's call it the white fleet of the world. And the fact that you have a slowdown in demand in Asia, cargoes keep getting pushed to Asia, and the ships don't necessarily get out of Asia in a timely manner. So you actually increase the need for ships on a go-forward basis.
Matt, let's dig into this comments interjection in the market yesterday by His Royal Highness Prince Abdulaziz, the Minister of Energy of Saudi Arabia, who signaled the need, the plan to stabilize the market by cutting supply. I'm wondering, as was sort of indicated on this podcast on Sunday by one of our regular commentators, Christoph Ruhl, he kind of forecast this, that they will find a narrative to fit the reality that's coming anyway, right? Russia is going to be, if you follow the European sanction implementation in the fourth quarter, they're going to be cutting supply because of the inevitable sanctions will reduce. So creating a narrative for an outcome that's already coming, is that what's going on? Your thoughts? Also, how real is this? They've announced OPEC Plus over the course of the last 9 months, production increases that are 2 million barrels or so ahead of where they've actually not meeting. So a cut from a fictional height. Your thoughts on the sort of credibility and the meaning of this?
I think it's a good point, but look, excuse me, like you said, the ultimate objective for the group and, you know, Prince Abdulaziz and where he stands, the dynamic hasn't changed. Are they there to protect prices for fiscal budgets within the core GCC and other oil exporting countries, or are they there to manage the supply and demand? He had a very valid point, and I'm sure Rustin will disagree with me, hopefully, but volatility at the moment, like I said, is a massive theme for this year. I mean, we're no longer the $10 a barrel swings we're seeing throughout the course of the day. We're still $5 a barrel. People are not. It was another swipe at the Wall Street funds who are getting into oil and futures as an asset class in order to make money, and detaching fundamental physical realities of supply and demand versus where futures prices are. Now, this argument has raged for a couple of decades now. It will never go away. The average length of a contract that's taken out on the ICE floor is 18 seconds. That's not someone who's hedging a cargo of Dated Brent to put into the pool. That is someone who's buying it and then selling it because it's a very liquid market. Liquidity has been an issue so far this year. It certainly has on oil products. If we move on to say high sulfur fuel oil, that's really come under pressure in sort of coming into mid Q3. It's still heavily backwardated and following the structure of Brent, but essentially volatility is what's killing the market, and it's not the people who are buying and selling crude oil, it's the funds. And it's another swipe. Last year he was infamously said, people who guess what OPEC do want to ouch like hell. I think that's what it was. It was a warning and a reminder that prices have come off 20% since the middle of June, and it's another reminder that the group will do what they have to when they have to do it in order to protect prices. So it's just the aggressive rhetoric following on from last year. That's what my opinion is.
Sarah, what do you think is more important right now for OPEC Plus? Keeping the group together and finding a consensus for a new agreement and a new reason to exist, or to, as Matt referenced, remove the volatility in the market? Saudi Arabia is more concerned about the volatility in the market, or he's more concerned about finding a strategy to keep OPEC Plus together? Your thoughts? And you're on mute again, sorry.
I think both these elements are important, not only for Saudi, but for the whole of OPEC. They would love to have a fixed price where they don't have to do anything, and that price would be there and trade around that fixed price. I mean, this would be a perfect world for all, because then they can plan their life, plan their economy, and so on. So they would love to have that ability to fix on a price, but of course that is not available to them simply because of all the other parameters. But removing this volatility so that they can have like a breather where they can truly plan their because most of these countries, oil is the single source of resource currently, and yes, we are diversifying, but that's a long-term kind of thing. At this point in time, it's the main source of revenue, and that's why the lower the volatility, the more stable they are, and the more they can control what they are doing, and they have ambitious, big plans for everything they are doing in their country. So price volatility is important, but they kind of are used to it. But to keep OPEC Plus as a cartel, that's a new reality. They've been operating like for 3 years now, and it's been working properly. They utilize it for various things, not only just to manage the market. They use it politically as well, as I said in one of the meetings, to bring views together to try to keep channels, for example, between the Iranians and the Saudis. There is lots of discussion that goes within OPEC, which doesn't go outside of OPEC. So they need to keep those channels open for all to be able to discuss bigger issues. And as you know, oil is not simply commodity that trade in the market. It's a very strategic commodity, and a lot of politics are involved in the way it is managed. So to keep the cartel together is a very important objective, to keep the balance and the powers they have created over the last 3 years.
Rustin, in some ways, it's kind of a free lunch for OPEC Plus to signal or even announce OPEC cuts when they've got a production level that's fictional. They could cut from the fictional level. If Nigeria cuts supply, their quota is way above where their production is anyway. So it's kind of like a no-brainer. Announce it. We'll cut from the fictional level. We get a few extra bucks on the barrel. Your thoughts on that thesis?
Well, I think that's part of what happens here is that you end up with they're underproducing by 2.9 million. So if they're underproducing against their quotas, to do a cut, you get a response from algorithms and from other electronic trading funds. But in reality, it does nothing to the market because the market is still in an oversupplied situation. I think and Saudi realizes that because they see where the actual demand is sitting because they're a producer. They see, prices are going down. The refinery runs aren't really necessarily ramping up as much as they'd like to see happen. Product demand is down. So they're trying to anticipate where the market is going to head. So you make a statement like that in order to support the floor of the market, because I think the fear in the market is not so much an OPEC reduction, it's Saudi doing something outside of OPEC, like they did back in 2020, where they cut the additional, 4 million from their own production to help balance the markets. So if Saudi comes out and says, if OPEC says, okay, we're not doing anything, we're not going to adjust our production, and Saudi, after the OPEC meeting in September, says, we're cutting 1 million barrels, that's what the market is more concerned of than a OPEC cut. Because Saudi does have that capability and Saudi can move markets in that response. But I think their general fear is that, yes, they've made a ton of money this year. They're swelling. They have much cash revenues, cash stocks to the nth degree. They don't want to lose that. And so, of course, they're going to try to support the market as much as they can. The unfortunate side effect of all that is they're basically going to keep pushing how bad the recession is going to be on a global basis, and probably more to a global depression than just a recession.
Matt, can you tell us a little bit about your interpretation of the collapse in the backwardation in the markets from like $10 to 10 cents over the summer?
Very good question. I mean, again, you look at not just crude. I mean, well, okay, let's look at, so where September to December, where that structure was trading. That was close to $9 a barrel. It was incentivizing no one to do anything when it came apart from just selling prompt oil. And it was one that seemed to be a bit off concerns during the summer about supply, and that they would get a little bit easier as demand waned, as we usually see through the end of Q3, start of Q4, we come into maintenance season in refineries. It started to pick back up a little bit now. I think because, like I said, the rhetoric around supply concerns is really going to rear its head, say in November. It's still strong, Sean. I mean, I know Russ said about freight, and we've been keeping our eye on freight as well because they have roofed. I mean, VLCC rates have gone up, I think 50% in a month, Russ, or something, right? So
no, more like about 100%.
Right, there you go. And so it's a great time for ship owners as well. I know Euronav shares are doing very well, Mr. Edwards. Thanks for the heads up about that, by the way. I could have done with that tip. But backwardation, obviously, the lower it gets, it incentivizes people to come into the market and look at possible storage. And people are taking out sort of 3-year time charters on big ships right now. Whether that's in the wake, Sean, of thinking that there's going to be an oversupplied market, and we're going to be in a global depression or recession, like Russ said, and it just means that market structure levels off and they can lock in some of their ancillary costs with these big time charters. I don't know. I don't know if it means that the fleets are going to become ever more fractured, one for the Russian or Iranian or the Venezuelan side, with all these sanctions still in place, and one for the accepted market, if you like, the non-sanctioned. So I don't know if that means that the fleet is kind of fracturing there. But look, all of it is a culmination that people, I would say, overbought structure because they were concerned about immediate supply being taken off the market, and it just went doolally. I mean, I think August, September structure on low sulfur fuel oil in Singapore went to $90 a ton. It was chaos. You know, people didn't know what to do, and it goes back to this volatility story that it will gap 50 cents a barrel. People will pay up or sell through just to get it done, and that's not good for stability in oil markets.
Sarah, the other big story, of course, that which OPEC Plus may be preparing for with this announcement yesterday by the Saudi minister was the fact that Iran may be coming back and making space for Iran. Your thoughts on these sort of latest soundings that a deal is imminent? We've been here many times before. Your own thoughts, and you're on mute again. Sorry.
Yes, you're absolutely correct. You know, the two big changes that politically speaking over the last month has been the amount of fuel people are using to make military maneuvers between various parties, and the action that took place around Taiwan. That was big news. And everyone, I mean, it was really a bad moment for the world because I don't know where we were going with that move from the US to visit Taiwan and try to, create some kind of turmoil in that part of the world. But the other part is that, again, the Iranian deal is on the table again, and they are negotiating, and there is some compromise from Iran, some compromise, I think, from the other parties. And it looks like they have agreed the details, a lot of the details that were outstanding in the deal so that they can progress. Probably, according to all the news I hear, is they will sign a deal before the end of this year. And if they do, genuinely, I don't think there is more oil in the short term that is coming from Iran, because simply Iran is actually exporting that oil already through various mechanisms they have, like barter mechanisms, whatever. So the additional crude that come legitimately to the market is the same that they are selling. But on the longer term, probably they can medium term. And within 2-3 years, I think they can bring some more crude into the market by some of the long hanging fruits on some of the fields that they can develop in order to enhance their ability to produce. But genuinely, on the shorter term, I don't see they bringing the 1 million barrel people talk about. I think they're already selling that 1 million and through various mechanisms to the market. So there isn't much to be expected, except that it will become legitimate deals. They can get their money directly through the system rather than the twisted routes they have now.
Would it be, Sarah, a bonanza for your peer group of supply chain oil field operators? I mean, Iran opening up, they need to rehabilitate all of their reservoirs.
Well, Sean, the most difficult people to negotiate with and get a deal are the Iranians. So to negotiate a deal, it will take you 1 or 2 years because they are so difficult in their negotiations. And, even during the last agreement they signed, after the last nuclear agreement, people thought, oh, now Iran is open, we can go and do business. Who did business? Nobody. It is so tough to operate and to get a deal. I mean, once you get a deal, probably it will be easy, or not easy, it will be okay to work and try to execute. But to get a deal with the Iranians is really tough. So I think they shoot themselves on the foot by that, really.
And they have done that a few times over the last 20 years. Let's go to the survey question on this sort of summer change. Whether the sentiment has shifted in the market. Oil markets went into summer with dominant concern being supply shortage, and now emerges from summer with demand destruction dictating sentiment. I mean, that's supposedly what we heard yesterday from the Saudi minister, but do you agree with this statement or disagree? The dominant sentiment has moved to demand destruction and not supply anymore. Rustin, China seems to be moving from one difficult moment to another. Now, this incredible heat wave they're experiencing, just shutting down so many different things. But what are you seeing from a shipping point of view vis-a-vis the ports, port congestion, activity, prices, freight rates out of China?
Well, port congestion is still pretty high. I mean, you can look at container port congestion in the United States. The East Coast has become another logjam. So it keeps going through this kind of feast and famine cycle where you have increased traffic flow because all these ships show up and you get big port congestion and then they kind of wean away. But I think operators are getting better at scheduling their arrivals so they don't have 20 ships showing up at the same time. They'll have them slow steam across the ocean and show up with a just-in-time mindset. You still have the congestions in the ports, and mainly what's going on now is that the supply chains in China are getting hit once again because of the rolling blackouts being caused by the major drought that they've been experiencing. The heat wave is one thing, but it's the fact that I think their rainfall is like 50% below where it's supposed to be this time of year, and it's basically they've drawn down most of their reservoirs along the Yangtze River and the Yellow River in order to as they were trying to supply and keep industries running. Now they're at the critical levels where they were starting to the rolling blackouts. I was reading an article this morning that they're shutting down the lights in the cities now because they want to conserve power. So with all of this going on, it does say that China's economy is not roaring ahead and roaring to life. It has more headwinds in front of it than anything else. Because if you're going to start curtailing factory production, that's going to start impacting, again, supply chains once again. Semiconductor demand is seen to be dropping. So you do have that forward guidance from the big semiconductor producers in South Korea and Japan saying that we don't see the forward demand and therefore we're not going to produce as much, which is kind of counter to the story that was going on in Q1, where everybody was saying, well, there's no semiconductors, we can't build things. So everything is starting to normalize in the supply chain. But again, it's that accordion effect coming in and coming out. So I think we'll see another squeeze coming in where ships will show up, but there's nothing to load because factories aren't running at capacity.
Matt, the other big story this week coming now is the Jackson Hole, the Fed central bank governor, to give a speech on Friday, giving a sort of outlook to the dot plot, as they call it in America, in terms of where interest rates may be going. I'm hearing on the Cole podcast this morning that stagflation looks pretty real here. We've got the Saudis talking about keeping oil prices high. The production in China down, so the supply of your next Apple iPhone is scarce. So price of that sort of scarcity elevation on prices. The inflation looks like it's bedded in tight here. The Fed will have no choice but to maintain a strong line. Your thoughts on what the outlook for that is and what it means for the markets?
Yeah, I think you're right. I think a hawkish Fed is feeding a lot of people, and that rally on the dollar, as Peter said, from XE, that it's relentless. Cable's 117.26 right now. It's dollar sterling. It's on a run. I can't see it coming any other way. I think what needs to happen, Sean, is all these interest rate hikes, are they dampening consumer appetite? I mean, my wife is a mortgage consultant here, and interest rates have increased dramatically in the UAE because we follow US fiscal Fed policy. It's as busy as it ever has been. I don't see that being dampened in any way. What happens with inflation? I think you're right. I think we're in a stagflated market. How does that translate back into the crude oil market? Look, I think there's two things here. And one thing to clarify is that Prince Abdulaziz, he said the vicious circle is amplified by the flow of unsubstantiated stories about demand destruction. So I think what he's saying there is that he's not seeing demand destruction, but the rhetoric seems to be that people are talking about it, and it is creating this market where, demand isn't as good as it was. Yesterday, the oil market was clearly focused on one thing. And like I said again, I'll say it one last time, it's about the supply concerns that people have got. Demand, okay, we all know it's gonna do its thing. But you said it a while ago, a few minutes ago to Russ, China. When China come back, that demand should then increase, should pick up. When that will be, no one quite knows. But I think the big things that people will watch for, will be PMI numbers that are coming out later this week. from the US, and what that does to the Fed, what that does to the dollar. I can only see that going one way. And then what happens with China and demand coming back? I mean, even with all these issues, no China, supply bottlenecks, apparent supply still in the market, and low demand because of high prices themselves, we're still at $97 a barrel on Brent. You know, it's got a long way to go up, I think, before it has down.
Sarah, we're also facing this week the 6-month anniversary of the Russian invasion of Ukraine. This incident of the weekend with the murder of this young lady, daughter of a senior advisor to Putin. Where do you think that goes and its relevance for the energy markets?
Well, you see, the biggest relevance is to Europe with the gas. I think that is the biggest impact of this war to the energy market, because the gas prices are crazy, and we are about to go into winter and fall and winter. So how is Europe going to survive this next winter is the big question related to the energy market. But there was an attempt to have a meeting. I think Erdogan was trying to mediate between Ukraine and Russia, trying to bring them together so that they can come to a kind of resolution, which everybody said at that time, now it's a long shot. So I really don't know, but it looks like they are going not only into the formal war that is happening in Ukraine, but they are using some techniques that, like assassination and all of this, which is really bad and escalates rather than de-escalate the current situation, which will impact the energy market for sure simply because of Europe and the gas requirements of Europe.
Let's get the survey result. And Rustin, last word this morning. They agree, a big number agreeing on that. Rustin, your thoughts, just sort of following on from Sarah, vis-a-vis Europe's ability to continue the course on Russian sanctions and the oil that's to be blocked from December, I think the date is, the European appetite to hold the line and all of that?
Well, I think Europe is going to hold the line politically. I think the problem is going to be the pinch point around energy supply to the consumers, and Europe is trying everything it can to support the consumer and the home consumption. So I think we will see continued slowdown of economic activity. Factories are already cutting back production runs in Europe because of the high cost of energy. And it was a point that I was making yesterday to a few people that, nat gas going up 20% day on day on day on day on really destroys your economics if you're a guy running a factory, because at some point that cost of input exceeds your profit margin and your ability to pass it on to your customer. And so I think that is what is happening. And that's why you do see this complete derailing of the euro and the British pound versus the US dollar, because currency markets are already pricing in a major slowdown in the European economy. And that's how they're expressing it. They're expressing it in weak currencies versus a stronger currency that's more stable, as in the US dollar. I think as we go into this winter, going into December, I think Russia's in the catbird seat. They've found buyers for the majority of their oil, and they're not concerned. So Europeans going to shut their own valve off on the crude versus waterborne, and that crude waterborne is going to go to other ports. I mean, they've already made contract agreements with Myanmar, crude supply into Sri Lanka, crude supply into other areas that were struggling buying crude in the open market. So Russia is supplanting the normal commercial flow, saying, hey, we'll help you out. And the world agrees, and the world will do it. I think the US is running out of ammunition as to what they can do, because pretty soon, they're going to be sanctioning half the world if they keep going down this pace. And at that point, it's like, okay, well, what good are sanctions if half the world is under sanction? So I think
if half that world is major commodity producers
and consumers. I mean, they're warning Turkey. Turkey, great crude supply into the Izmit refinery and all their other refineries from Russia, and they're telling Turkey, stop doing that. I mean, Erdogan's probably going to say, yeah, no thanks, Joe. We're going to keep doing that. And if you're going to sanction us, that's fine. There's half the world that's on our side.
I have to go back and study my Roman history as to the last days of Rome. Was this the same problem that the sort of hordes on the perimeters of the empire were no longer listening to the decrees that came down? Perhaps that's what we're witnessing in all of these no thanks, Joe letters. We're going to have to wrap it up.
I mean, one last point I want to make on it is that you have the JCPOA. Europe needs the crude because they need to supplant the Russian supply. So does Europe tell, if the Biden administration and Iran can't come to terms, will Europe say, you know what, US, we're still going to buy the crude? Because their economic destruction is far more valuable than US sanctions on Iran.
Well, ultimately, the question I have looking forward is how much oil is going to be burnt over the coming winter because it is so cheap at $100 a barrel versus natural gas in order for power generation, a whole new kind of perhaps, I mean, if people are going to start up coal-powered power plants or restart nuclear power plants, why, burning coal or crude rather or your furniture in your front room. But nonetheless, this story will go on and on. Rustin, great to have you back. Matt, great to have you back. And again, congrats on your new Kepler post. Sarah, thank you so much as always to be at the table. Really appreciate your insights. Have a great day, everyone. Every morning, 10:30, the Daily Energy Markets podcast. All the best.